Welcome to Early Age Club, where we break down one microcap or SME stock a day using a simple structured 20-factor scorecard. Microcap investing can be rewarding, but it's also full of traps. Our goal with this series is to help every retail investor avoid the common mistakes and develop a more thoughtful approach when it comes to investing. If you're new here, I recommend checking out the explainer video on how to use the scorecard. Try scoring the company yourself as it will give you real hands-on clarity. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. This company analysis and discussion are part of our internal conversation as we review companies from our ongoing 500 plus microcaps and small cap stocks. We are sharing this to retail investors can build a structured framework when it comes to microcap investing. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company that we will be analyzing today is ECOS Mobility and Hospitality Limited. The company was incorporated in the year 1996 and the initial public offering in 2024. So they are chauffeur car rentals, that is the leading corporate mobility and hospitality firms with extensive operations across India and globally. And coming to their financial health, in FY25, they did 626 CR of revenue. And one important thing to notice is that the IPO was for only offer for sale. Coming on to the business overview and market position, the operations are conducted in 100 cities and only in 4 cities so far they offer for self-drive cars. In the remaining cities, that is more than 100 Indian cities, you get a driver assigned to you for your car rental. And their asset base is about 14,000 vehicles, and they have partnership with over 5,000 vendors. One important thing to notice is that about this 14,000 vehicles mentioned here, only 6 to 7%, that comes to about 800 vehicles are actually owned by the company. So that makes high reliance on the vendors for their use of vehicles. Coming on to the revenue contribution, the employee transportation services account for 55% of the revenue, and the chauffeur car rentals about 40%, and other hospitality events account for less than 5% of their revenue. And this revenue, we will see in the financials when we'll go dig deeper that after lockdown, when things and the offices started resuming, their revenue also saw a surge. So we'll talk about that also. Coming on to the market landscape in Indian corporate mobility market, it is about 85% of the unorganized rentals that play a major role. In the remaining 15%, our company that is ECOS Mobility, they play a major role. They have wide range of vehicles from premium segment to luxury segment to basic segment, eco segment, and buses and coaches as well. Here are some examples. So for premium vehicles, they have their Fortuner and Innova and High Cross. And in luxury, they offer Audis, Mercedes, and BMWs as well. For economy, the preference of choice is Maruti. And now we'll see the FY25 mix. Two major cities had the maximum revenue were Bangalore and Gurgaon. Bangalore accounted for 19.6% of the revenue in FY25, particularly in the last quarter, and Gurgaon 14.8%. Now, Rajesh Lumba has the highest stake in the business, that is 32.26%, and Aditya Lumba has about 25% stake in the business. They have demonstrated robust revenue growth, as I've told you, and in FY23, due to post-COVID reopening, increased corporate engagement. Also, receivables have declined due to better collections. Now, we'll see this graph on the left side, that is about the revenue from customers that are with ECOS for more than 5 years. And we can see that the relationship has produced better returns as the number has increased to 61% as of total revenue. Coming on to the governance, the board composition for FY25 was 6 directors and 2 independent directors being the brother. The family on board is 3, as there was another person. And coming on to the auditor and credit opinion, SS Kothari and Mehta, they have unmodified opinions. They were appointed pre-IPO and they're still the auditors. And CRISIL has given stable ratings as well for FY25. Now, coming on to the business concentration risk, the company has 33% of its revenue coming from top 10 customers, and also GCC clients, they account for 66% of the revenue. Now, by GCC, the company basically refers and demarcates all the ITs and big corporates under this. So 66% of the revenue is from that side of the business. Now the vendor relationship. Business relies on vendor relationship for vehicles and shoppers with no long-term client contracts. As I have mentioned earlier, that might be a problem in the long case, as their assets, as their cars are also only 7% of their total car rentals. They're also trying to expand in tier 2 and tier 3 cities. So far, their penetration has been high in tier 1 cities. This is Indian map, and we can see that 14 cities that are in dark green are their four own offices, and the remaining 95 have presence through vendors. Coming on to the key takeaways and outlook, they are the largest organized players in the car rentals and the corporate mobility in India. Their client base include 42 Fortune 500 companies, 60 BSE 500 clients, and also they have acquired new 188 clients in the FY25. So that is again a very good thing, as they are doing great with their previous customers, their previous clients, and also acquiring new clients on the way. Their future outlooks, the management believes that 15 to 18% of revenue growth will be there, and they will keep stable EBITDA of 13 to 15%. And this is despite rising competition from unorganized and organized industry. And also the organized industry is set to grow at 12.7% CAGR. And there were also 161 new EV vehicles that were added. Their overall score came to about 90, and 46 for the governance and 44 for their financial health.
Before we deep dive, quick note, we are opening Early Edge Club to a small founding cohort of 15 to 20 serious microcap investors. We are building a research first community where we break down businesses together. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. So the current valuation is around 32 PE, and considering they are forecasting to grow just at 15 to 18%, let's see if it is attractive. At the current price is around 300. They came up with the IPO recently, and there has been correction because they came at a higher valuation of around, I think there was a listing gain, and then around 40 PE. It has been corrected to
Right.
20 PE, then now it's currently at around 31 PE. And okay, this growth has been, since this is a tool that extrapolates previous year growth, this is not the best case. This worst case would be your ideal scenario, which would be the next year revenue. And the margin is going to be 15. They expect the margin to be around 15%. And
Correct.
if you, let's be conservative and put 20 PE, your price is at 232. Currently, the price at which it is trading is it at a bit of a premium. If the stock comes to around maybe 200, 225 would be a good time to accumulate this company, according to me. Currently, it is at a premium based on 1 year forward PE. However, if your holding
Right.
period is longer, considering their profit before tax is 92, and this year's profit before tax is 76. Yeah, so you take that, be conservative, and if your return expectations are 20%, terminal growth rate at 5, number of years 5, and your ending P multiple is at 20, the company has to grow at minimum 18%.
18%.
Yeah, for you to realize 20% CAGR. 18% is something the company expects to do, 18 on the higher end, but 15% is what they are saying. So maybe your
Yeah.
expected growth
So
rate.
these implied,
Yeah.
sorry to cut off in between. So this implied earnings is 18%, but the
Yes.
management, the bottom line is expecting about 13%,
In the
13 to
bottom line,
15%.
13 to 15%.
Yeah,
Okay, so in that case, you will not realize a 20% CAGR, right? If the management is going to is expecting 15%, you say, if you say you're going to get only
right.
around 15% CAGR with this company, considering your trade 5 years multiple as 20. But if you, I mean, there are other moving factors, but then conservatively, you can expect 15% CAGRs over the next 5 years. But if you're
All right.
taking 1 year view, the price is
Hmm.
fully priced in at this current price. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20 factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye bye.